We're jumping straight into USA rare earth today. Everyone is watching the price action, and the volatility has been absolutely relentless. But the real structural story here is the critical transition from development stage to domestic magnet manufacturing revenue. That is the fundamental pivot point for the business.
It is, and that's a really sharp distinction to make, and it's critical for you to understand. You have a company here that's, currently sitting pre-revenue, but it's controlling a massive geographically constrained asset in West Texas.
Right.
So this isn't just some basic materials play. It's a high-stakes convergence where geopolitical urgency meets the brutal reality of execution risk.
Exactly. And we've seen that tension play out in real time. The stock is currently trading around, what, $14.22 as of mid-January 2026. And if you've looked at the chart over the last few months, I mean, it looks like a heart monitor.
It really does.
We saw that massive, just dramatic 28% surge in early December 2025. And that was right after those critical new supply deal announcements.
And yet, right on the heels of that surge, we saw that noticeable 7.16% pullback. And that was driven by market whispers and news citing production delay concerns. It shows you investors know the reward is massive, but the clock is ticking. The risk is real.
Exactly. You're tuned into the Easy Mini Show, where we make sense of the market's biggest moves. I'm glad you're with us. Our mission today is to simplify these intense market dynamics, to clearly outline the potential 85% upside versus the intense binary execution risks, so you understand precisely why institutional money is piling in right now, despite the bumps.
We're going to peel back the layers on this complex business case, giving you the specific insights you need to navigate this very volatile stock.
Before we dive in, if you want more in-depth analysis delivered straight to you, make sure you subscribe and hit the like button. Okay, let's unpack this. So we have to start with the bull case, because structurally it is incredibly compelling. The core bullish driver here isn't just the resource, it's the timing, specifically the planned commissioning of the Stillwater magnet manufacturing facility. This event slated for the first half of 2026, and based on what we're hearing, we're looking at a likely window of February or March. That is the inflection point.
That transition is everything. For a development company, going from spending cash to generating revenue, it just changes the entire investment narrative instantly. Initially, they're planning for a 1,200-ton capacity production line.
Okay.
But the crucial detail is the rapid roadmap to scale up that facility to nearly 5,000 metric tons annually.
And that's where the significance lies, right? A 1,200-ton output proves the model works, but 5,000 metric tons makes them a strategically relevant player in the North American supply chain. This leads us right into what I see as the truly defensible advantage, the vertically integrated moat, what the company has termed its mine-to-magnet strategy.
Right, and if you are looking at the financial statements, that mine-to-magnet strategy immediately addresses your profit margins. Traditionally, a mining company sells its raw materials, often in bulk, to a third-party processor, usually in Asia, who then turns it into a magnet and takes a massive cut. This integration, moving from raw material to finished, high-value magnet, is designed to capture all of that value across the entire supply chain.
So instead of capturing just the commodity margin, they get the high-margin manufacturing profit as well?
Exactly. By owning the entire process domestically, they bypass the 30% to 40% margin usually absorbed by those Asian third-party separation and manufacturing facilities. That immediately boosts their future gross margins on the final finished sintered magnet product. That's why this model drives superior unit economics.
That is a huge financial advantage. Now, let's break down the physical and technological pillars supporting this moat. Pillar 1 is the pure asset control. Tell us about Round Top Mountain.
The Round Top deposit in West Texas is genuinely world-class. It's a multi-decade asset, which guarantees long-term supply. Critically, it contains 15 of the 17 rare earth elements, and perhaps most importantly, it hosts significant concentrations of the heavy rare earth elements, or HREs. Specifically, you're talking dysprosium and terbium.
And why do those two names matter so much to, say, the defense sector or to an EV company?
Well, dysprosium and terbium are the crucial components that allow powerful permanent magnets to retain their strength at extremely high operating temperatures. So if you're building an advanced EV motor that runs hot, or maybe a guided missile system that needs precision in a high-heat environment, you must have those heavy rare earths. China currently dominates the mining and processing of HREs, making Round Top a true strategic asset for the U.S.
Okay, that covers the resource. Pillar 2 is the technology needed to process that material, which historically is, well, toxic and expensive. They use a proprietary process called continuous ion exchange, or CIX. We need to simplify that for everyone.
Think of it like a high-tech water filtration system instead of, traditional messy chemistry. Traditional separation uses solvent extraction, which is chemically intensive. It creates massive amounts of hazardous waste and requires huge facilities with large tailings dams.
Which is often an environmental nightmare.
Precisely. CIX is a modular, closed-loop system. It's cleaner, it requires fewer chemicals, and generates significantly less waste volume. The fact that they can refine the material on-site without the massive environmental headache of legacy methods is a huge competitive and regulatory advantage. It allows them to bypass the long, difficult permitting issues that plague competitors using older, dirtier methods.
So if they have the asset control and the clean tech, pillar 3 is the geopolitical positioning. And this is where the money is, because the demand isn't just commercial, it's mandatory.
It absolutely is.
Yeah.
I mean, China currently controls over 90% of global sintered neodymium magnet manufacturing. The U.S. government and critical U.S. industries, defense, aerospace, EV, they simply cannot continue to rely on that single supply chain. USA Rare Earth is explicitly positioning itself as the sole domestic secure alternative. This creates a massive regulatory and government procurement moat around their business.
And that structural demand is already validating the business model. We saw the early commercial traction with those new supply agreements announced in December 2025. That was through their less common metals acquisition. And those deals prove the product is needed and the timeline is urgent.
Analysts certainly agree on the upside. The average 12-month price target is, well, it's high at $26.33. That implies an 85% upside potential from the current $14.22 level. That huge gap signals two things: high potential and the market pricing in significant risk right now.
That's a good point. Is that $26 target based on the initial 1,200-ton output in Q1 2026? Or is it already pricing in the successful multi-year ramp up to 5,000 tons? Because if it's the latter, that means analysts are already highly convicted on the execution.
They are. And we are seeing that conviction expressed not just in price targets, but in institutional behavior. We've seen established, typically cautious players engaged in what we'd call heavy buying recently. Firms like Calamos Advisors and Darwin Wealth Management and major desks like Bank of America and Geode, they're all accumulating. They are clearly betting that the H1 2026 timeline will hold.
It's fascinating. Bank of America is typically slow and cautious about pre-revenue development plays, yet they are diving in here. That tells you they view the political tailwind and the strategic need for this asset as, well, almost guaranteed revenue once the plant is operational.
And let's not forget the structural positives that provides a floor for the stock. Index inclusion. Effective December 22, 2025, USA Rare Earth was added to the Russell 2000 and Russell 3000 indexes. This is crucial because it drives passive inflows. Funds tracking these indexes must buy the stock, which boosts liquidity and acts as a baseline structural support for the price.
Okay, so we've established the 85% upside case, which is heavily reliant on the Stillwater commissioning. But that brings us directly to the flip side. Since this is still a pre-revenue company, the risks are intense and very concentrated.
Absolutely. The entire investment thesis rests on two primary risks. And risk number one is the binary execution hurdle. The biggest danger is a delay or underperformance of the Stillwater facility commissioning past that H1 2026 window. A pre-revenue company lives or dies by its construction timelines.
And we already have signals that this is a real concern. Recent news has cited unexpected production delays in a key magnet project. If commissioning is missed by, say, 6 months, or the ramp is much slower than the 1,200 tons they are planning initially, the market reaction will be immediate and brutal.
Oh, absolutely. We project that a significant slip could easily trigger a sharp 20% to 30% correction in the stock price, simply because it raises doubts about management's ability to deliver on time, which then raises questions about long-term financing and capital expenditure requirements for that 5,000-ton scale-up. Execution failure means higher cash burn, which means further dilution risk.
Right. If they can't prove the model in Q1 or Q2 2026, the cost of capital just skyrockets. Now, risk number 2 is geopolitical volatility. While the domestic focus is their strength, they are still operating in a global commodity market.
Exactly. Recent reports have cited export curbs as a near-term headwind. If trade tensions escalate between the U.S. and China, there's always the risk of disruption either to inputs or competitive pricing. However, this is also where the moat offers strong mitigation.
Let's assess that mitigation. You could argue that the domestic-first strategy serves as a near-perfect hedge against export restrictions rather than a vulnerability. I mean, tighter controls by foreign producers, say China restricting exports of refined materials, that would only dramatically increase demand for the high-margin, domestically sourced product.
That is the core analytical takeaway. Any escalation that restricts the global supply of heavy rare earths is a direct, massive tailwind for Round Top. It solidifies the strategic importance of the company. Also, keep in mind the market is already pricing in some of this execution risk, evidenced by that recent 7% pullback. Analysts maintain that high upside target, suggesting they view these risks as temporary and manageable, provided the commissioning happens successfully.
So, if we accept that the risk is binary but the reward is high, what specific calendar triggers should you be watching over the next 30 to 90 days? These are the events that will determine the immediate price action.
The highest impact event, bar none, is the Stillwater magnet facility commissioning. We are talking likely February or March 2026. This is the moment the company transitions to revenue and validates the business model. You need to be listening for the press release, announcing that the first production magnets have been successfully manufactured.
Right around that same time, you'll have the Q4 2025 earnings release, probably late February 2026. We should fully expect continued operating losses, of course. They are still in that heavy build-out phase. But the critical factor is management's updated guidance on the facility ramp timeline and progress. Any slippage there will be highly scrutinized by the market.
And beyond the internal timeline, you should watch for customer wins and visibility. The December supply deals were a strong start, but we want to see announcements of named blue-chip customers. Think major EV manufacturers or high-profile defense contractors that clearly build on those initial deals. Those named wins provide tangible, de-risked revenue visibility.
And then there's the big one, the speculative catalyst. The high-impact event that isn't guaranteed but would change everything. The possibility of securing a major, multi-year government contract, whether from the Department of Defense or the Department of Energy.
Given the alignment of the company's mission with the geopolitical need for critical mineral security in the U.S., securing a DoD or DOE contract would provide long-term revenue certainty. It would eliminate most financing and demand risk. It would grant them a huge premium because they effectively become a subsidized strategic national asset. It's speculative now, but given the landscape, it's a very credible near-term possibility that is driving that institutional interest.
Okay, let's wrap up with the final lowdown. USA Rare Earth has a highly defensible moat driven by its vertical integration, that mine-to-magnet model, and the structural geopolitical demand for a guaranteed domestic rare earth supply, especially for critical sectors.
The focus now for the next 60 to 90 days is entirely on that one binary event, the successful commissioning and ramp-up of the Stillwater facility. Everything else is just noise until that point.
The institutional money is clearly betting on successful execution, loading up their positions even after the recent pullback over delay fears. The question you need to consider as you look at the stock trading around $14.22 is whether that price fully discounts the possibility of a 2 or 3 month delay, or if the potential 85% upside makes the volatility worth the ride as they approach their production date.
That is the high-risk, high-reward bet you're making right now, factoring in both technical execution and political necessity.
As always, thank you for tuning in and trusting us to simplify the complex market moves for you. We'll catch you next time.